we have an economic roundtable to unpack that 500 billion rand stimulus plan, a historic plan at that, announced just yesterday. Joining me right now is Isaac Machego, who is an economist at Nedbank, Leanne Buck, the Director for Tourism and Travel at BDO, Martin Kingston, member of Business for South Africa, and Johan Els, Chief Economist at Old Mutual Investment Group. And guys, thanks so much for your time, really. And before we really get into the conversation, I'd like us to kick off by first listening to what the President had to say last night, refreshing our memory on that 500 billion rand stimulus budget that he announced just yesterday.
Our economic response can be divided into three phases. The first phase began in mid-March when we declared the coronavirus pandemic as a national disaster. This included a broad range of measures to mitigate the worst effects of the pandemic on business, on communities, and on individuals. The measures included tax relief, the release of disaster relief funds, emergency procurement, wage support through the UIF, and funding small businesses. We are now embarking on the second phase of our economic response to stabilize the economy, address the extreme decline in supply and demand, and to protect jobs. As part of this phase, we are announcing this evening a massive social and economic support package of 500 billion rand, which amounts to about 10% of our GDP. The third phase is the economic strategy we will implement to drive the recovery of our economy as the country emerges from this pandemic.
All right, a massive and historic stimulus plan. And Isaac, I'd like to begin with you. Let's rate the response from Cabinet that we did hear last night. If you had to give a rating to the President on a scale of 1 to 5, how would you rate what was announced yesterday?
Well, Fifi, I will say that as an initial crisis plan, I would give it a 5. Because remember that government is dedicating about 500 billion, about 10% of GDP, when it does not fully know what the likely impact of the lockdown, for instance, will be on the economy. So basically what I'm saying is that as a start, I do welcome it fully, but of course, once the economy gets back to operation, and we start seeing the full, or at least the initial effects of the lockdown, then it can be revisited.
So 1 to 5, I didn't quite hear your rating.
I mean, my rating would be a 5 for this one for now.
A 5 for now. Okay, Martin, just to bring you in, and I did read the statement that Business for South Africa released as a result of the announcement that was made yesterday. You are also pretty happy with what was announced by the President yesterday. Would you give him a 5 or Cabinet a 5 as well, or is your rating not as high?
No, our rating is exactly as high as Isaac's is. There's no doubt that this is a very bold and necessary step. We need fundamental levels of confidence to be restored to the economy, and this type of
All right, Martin has, we've just lost him for a second. We will pick up on that conversation in just a moment. Leanne, bringing you in here, and I don't know if you're going to speak specifically on behalf of the tourism and the travel industry, which I don't think was given much attention at this stage or yesterday when that budget was announced, but just your general assessments of what the President did announce yesterday.
So yes, travel and tourism obviously wasn't mentioned. There was no industry sector mentioned. But in terms of what our president has done and in terms of the leadership that he's giving, I absolutely give him a 5 out of 5. We can go into a little bit more depth around the travel and tourism sector, which is obviously the sector, one of the sector that has been the hardest hit. But it's also going to take the longest to become out of the doldrums that it is in at the moment. And we have to be cautious. We can't throw good money after bad. We also have to be realistic about what is going to make it through and what's not going to make it through these very turbulent times. The focus on health, the focus on hunger relief and social distress are key at this stage, and it is where we need to focus at the moment, and reviving those businesses that can be revived.
Martin, I understand that you are back. You were talking about your response to the president's measures. You are equally as happy with what he announced, giving him a 5. If you can just pick up on where you had left off there.
Yes, I apologize. So we do believe that this is a very necessary step. Fiscal stimulus of this magnitude is critical. But as Isaac says, it's only the first stage of a recovery plan. In fact, we don't know for how long we're going to be not only subject to lockdown. We'll hear some of those plans, as you've indicated, tomorrow, but we expect there to be a gradual relaxation, sector by sector, geography by geography, depending upon the health protocols that are put in place to protect not only the workers, but those that they interact with on the way to work and on the way from work. But secondly, that we need to plot an economic recovery thereafter. We are anticipating a very significant level of contraction in the economy this year, regardless of the level of stimulus. This is really to support businesses, particularly small businesses, and those who are going to have social support by way of the grants that have been announced. It's not going to be able to give us the stimulus that we need to get onto an appropriate, sustainable economic trajectory. And the president alluded to that, of course, by talking about phase 3. So we're focusing as business not only just on the current circumstances, not just on what happens when we restart the economy, but equally importantly, on what happens post a COVID-19 set of circumstances, recognizing that we're in the downgrade. And this type of stimulus is critically important to give the country an underpin, both in terms of confidence, but also in terms of actually addressing the requirements of both the most vulnerable in society and businesses that are taking strain in the current environment.
Quite a number of businesses taking strain. But Isaac, please help us with the numbers. I know that a number of economists have been doing the calculations on exactly where this money is going to come from and how much is coming from where. 130 billion rand, we are very sure that is going to come from, government taking money from other departments that don't need it right now, although we'll discuss the possible implications of that. But the rest of the money, the World Bank, the IMF, the New Development Bank, and possibly the Treasury coming to the bond market. Help us understand from your calculations how this budget is going to be funded.
Sure. Just a simple arithmetic of the numbers suggests that government is going to have to borrow only between 100 billion and 150 billion. So adding that to the budget deficit of about 370 billion that was estimated in the February budget, it shows you that, our deficit will go to 500 billion rand or so, which is equivalent to 10% of GDP. We believe that at least from both local and international markets, government will be able to raise that money, because remember that, about 200 billion is going to come from the commercial banking system, and that will be guaranteed by the government, and it will go to businesses in the form of loans, and that's quite crucial for helping small businesses in particular and the jobs that they sustain.
Johan, thanks so much for joining in on the conversation. We are continuing to do what everybody has been doing in the investment community, of course, today, and that is unpacking that 500 billion rand stimulus package that was announced by the president yesterday. And we're just discussing the funding mechanisms and exactly where all this money is going to come from. Of course, we've got the guaranteed 200 billion rand from the major banks through that loan facility. We've got 130 billion coming from reprioritizing spending from the other governments. I'd like to speak to you specifically on the amount of money that we are going to have to borrow. What are your calculations saying there? And perhaps just to take it further, is this the best way to go about getting that money? I mean, I was speaking with Brian Cantor yesterday, a renowned economist, who was talking about why borrow at such expensive rates when we do have a reserve bank that hasn't yet taken a bold enough stance by printing money.
Yes, hi, good afternoon. Absolutely. You mentioned some of the sources for the 500 billion package. 70 billion of that is just probably delayed tax receipts, so that's not immediate spending either. And the other 100 billion in terms of job guarantees or helping for unemployed probably will come from the UIF. But you're absolutely right in the fact that I also believe that the Reserve Bank could be a whole lot more proactive in this crisis situation. These are extraordinary circumstances that need extraordinary policy measures. So government is doing a lot. The central bank have cut rates and they've done limited QE in terms of liquidity support for the markets. But I truly believe they should come to the market with massive QE. In other words, the total no-no that we grew up with, that the central bank shouldn't monetize debt or shouldn't finance government's budget deficit. I think they should do this. I don't think there should be any worries about inflation at this stage. Inflation is heading towards 2% in the short term. And when there's any sign of significant inflation coming through the system, then policy can be reversed. For now, I think there's less risk in the central bank doing massive QE than not doing it. My own GDP forecast is minus 5.7%, and that is record territory. So we need massive central bank action. And they need to do it the way that the Fed has done it in the USA. Pre-announcing the numbers that they're going to put into the markets and the length of time that they want it to be there. So we need full transparency around this. That's the only thing that will help markets in there.
Martin, to get your thoughts on, how we're funding our way out of this crisis. The economists are worried that we're doing it in a way that is too expensive, and are worried that, we looking down, further down the curve, we might not even be able to rein in all the debt that we are amassing right now because we're taking the more expensive route. What's the view of business?
Well, that's true that we need to be very careful about our debt to GDP ratio. Obviously, we're going to breach ceilings that had previously been identified. They were concerns to the rating agencies. We're already into junk territory. The truth of the matter is that we need to access liquidity from all available sources at this moment in time, not just liquidity for the sovereign balance sheet, but liquidity so that we can support the banks that can assist the private sector very directly, because the sovereign is not going to do that. We're also going to have to take very direct action with respect to state-owned enterprises. The president again alluded to that yesterday. So it's both a question of raising capital from sources that hitherto we hadn't considered. A major source, of course, is the IMF COVID-19 facility that has no conditionality attached to it. The president also alluded to not only the African Development Bank, but the new Development Bank, the BRICS Bank, and the World Bank. We would endorse all of those. At the end of the day, we're going to have clarity when the Minister of Finance tables his budget. It'll look very different from the budget that we heard in February to form an accurate assessment. And I think the last point I would make on this issue is that all of our projections are only as good as the information we have to hand at the moment. Our trading and investment partners are themselves in disarray as they're trying to make sure that they can inject significant liquidity into the system. And none of us know for how long the pandemic is going to endure. In our case, of course, the surge is not anticipated until August or September. If you look at what is happening internationally, they're now anticipating second and even third surges elsewhere in the world. So we need to have a very, very prudent and conservative approach as to just how effectively we can reactivate our economy and how long we're going to be in a recession, or indeed, in our case, we believe it's going to be a depression, and how long it's going to take to work our way out of that. And we've got to have, as I indicated previously, an appropriate safety net, both for business and for individuals who won't be working but need to support themselves and their families.
Can we turn to the how this budget is also going to be used? I know 100 billion rand has been set aside for the creation of jobs and also the protection of jobs. And Lee, just to bring you in here on that, I mean, last I checked, our unemployment rate didn't reflect an economy that was, vibing in creating jobs, and that was pre-COVID-19 times. Now you've got the extra pressure from the coronavirus. What's your feeling on how effective this 100 billion rand will be in actually enabling job creation?
It's difficult to say. 100 billion rand doesn't actually go that far at the end of the day. I can speak specifically around the travel and tourism industry, where if we think about the fact that there are 1.5 million people who are directly or indirectly employed as a result of the travel and tourism industry, that has gone from a thriving industry to nothing overnight. That's an immediate 1.5 million. If they're all directly, there's around about 700,000 to 800,000 people employed in the sector. So these are people who are now unemployed and unlikely to see employment opportunities or significant employment opportunities in the near future, because travel and tourism is going to take a while to come back again. Only when international borders open will we start to see some trickle of international tourists coming back. And then after that, only when we've got either herd immunity or a vaccine that is accessible worldwide will we actually start to see the real flow of international tourism again, which our tourism industry is so reliant on. So we're going to be looking towards domestic tourism to try and stimulate that. But obviously the problem with that is the lack of disposable income. So supporting alone those 1.5 million jobs just from the domestic tourism industry is just not going to be feasible either, unfortunately. So in terms of stimulating, we can stimulate as much as we like. We still need to get people to travel. We still need to get people to spend money within the economy. And when households are suffering, little is going to happen in terms of travel and tourism spend. So this is going to be very tough. And I do believe we need to focus our money on those industries that are going to create jobs. We need to relook at the types of jobs that can be created, the types of industry sectors where we can make a quick turnaround in order to create those jobs and to stimulate the economy. So it's probably going to be in things like infrastructure, which the president did mention in terms of the infrastructure, the build program that he said he's going to mention and provide some more information on, which is probably going to be key for us.
Yeah, and of course that infrastructure plan, I do understand, is part of phase 3 of our response to the coronavirus. Johanna, I want to bring you in here, and I really want to find a lot more upsides to the announcement that was made yesterday, and staying with the issue of jobs, but focusing in on jobs from the 200 billion rand that is going to be made available for small businesses via the scheme that was set up with Treasury and the SARB and banks. So as I understand, this money is essentially to help these businesses fund working capital, so day-to-day costs and pay salaries and suppliers and the like. What is your reading and assessments on the multiplier effect of this funding, this lifeline for these small businesses? Maybe not only to create jobs, but also to protect jobs, or even more jobs from being lost.
Yeah, your last part of your question is very important indeed, because I think that the bulk of this package, whether it's the help for businesses or the jobs guarantee program, is very short-term in nature, and that is just trying to protect existing jobs or give employees that's out of a job a short-term benefit so that the economy can get going, to help those employees. None of this is medium or long-term enough at all to get decent job creation. The only way you can do that is by having much higher growth, economic growth on a sustained basis. Back in 2004, 5, 6, 7, when GDP growth was above 5% per year, then we did start to manage to get the unemployment rate down for a while. But over the last 5 years, annual average GDP growth less than 1% per year. So no surprise that we didn't manage to create any jobs and that the unemployment rate actually went up because we couldn't make any allowance for the new job entrants into the labor market. So absolutely, the funds now very crucial. It will help the economy. It does protect the downside risk from existing very bad GDP growth forecasts. But these are very short-term in nature. I don't see any of these money creating jobs, unfortunately. Yes, it's very important that we protect incomes for those workers out of a job. But I think to create jobs, we must wait for the second phase of what the president announced, and that's the economic reform policies that we need to get economic growth going. And I'm really looking forward to that part. We need this new economy, the reforms in the economy to get sustained high economic growth, and only then will we be able to make some inroad into the employment problem.
Yeah, and of course, I mean, what was announced or what has been announced so far is our elementary lines of defense. The first critical thing that we have to do is, limit people getting sick and limit people dying from this coronavirus. But Isaac, just, final thoughts as we enter phase 3 and we start talking about an economic recovery and we start talking about a recovery in which we're building a new economy and not the economy that we left behind. We don't want that economy. What should we be including in that a new economy conversation, as Johan was talking about? The economic reforms that the president highlighted would be mentioned, the structural reforms. What should those be?
Fifi, I said to you, unfortunately, we're going to have to deal with our pre-COVID-19 challenges before we even think of expanding this economy post the crisis. I mean, load shedding remains our huge problem. My biggest fear is that, should we see a very quick rebound out of this crisis, we are likely to be constrained by, the old problem, load shedding, towards a faster economic growth rate. But basically what we've got to get right is if once we get everything under control and we stabilize power supply and all that, we should stimulate the export sector. And that simply says that we are unlikely to achieve high economic growth rates until the global economy returns to normal, returns to the growth rates, for instance, we saw in 2017, 2018, even before the effects of, for instance, trade tensions between the U.S. and China. But definitely, an export-led growth strategy is going to get us out of our long-term troubles, long-term standing challenges, because we are a low-income country. We've got very limited capital in this country. Investment is quite low. And to get growth at the level that we need, the level that is going to stimulate job creation, we're going to have to attract investment, mobilize foreign direct investment.
A quick one, Martin, from you. To limit the time that South Africa's economy spends in a depression, what needs to form part of this new economy or the third phase of our recovery plan?
Well, Johan and Isaac have already referred to it. We'd identified as business the fact that there were many structural issues that needed to be addressed and addressed urgently. In fact, National Treasury had put out their paper at the end of last year, in November of last year, which we pretty much universally endorse. It had yet to be implemented. There's now no time to lose. Isaac is right. It would be very nice if we could attract investment. The reality is there's going to be very limited cross-border investment in the foreseeable future, not just to South Africa or Africa, but out of host countries, given what we're seeing happening around the world in the context of COVID-19. 2020 is going to be a year where we have to preserve the health of our populations as countries, build defenses for the future, as I said, but actually get ready to implement very radical and far-reaching reform. Now, in our case, we think that extends to particularly boosting the role of small and medium-sized enterprises. That means doing away with much of the regulatory red tape that has bedeviled them being able to succeed in the past. The president has identified that as an obstacle. It's dealing with state-owned enterprises and ensuring that only those that are systemically important play a critical role, and that the others are either closed or sold to more effective and appropriate owners. It means that productivity and efficiency features as the very critical objective of all of our industries, and prioritizing those industries and those sectors where we have a competitive advantage. Now, all of that has been highlighted in the past. The reality is that we've got the next few months to prepare for embarking upon that journey, because we're not going to be able to see full economic activity until the handbrake of the lockdown is fully released, and that is not likely to happen for several months.
Martin, many agree with you right there, and could go on, but we are out of time. Thanks so much for your time, and to everyone who joined in on this conversation. Isaac Machego, Nedbank economist, Leanne Bach, Director for Tourism and Travel at BDO. We've just heard from Martin Kingston, a member of Business for South Africa, and Johan Els, Chief Economist at Old Mutual Investment Group.